Welcome back to the Miami Real Estate Podcast powered by Cervera Real Estate. Today, we have your economic insights with Dr. Marcy Russell, Chief Economist, leading real estate companies of the world.
Hello, my friends. We are in our second to last Economic Insights of 2024. We are here to cover just a bunch of stuff. Obviously, big news in the U.S. We're going to cover all of that. We're also going to, we've been hearing and watching an increase with every Economic Insights that we've done over the last several years in our global participants. We're going to hit Eurozone. We are going to hit APAC. And of course, as always, we will hit the housing market. Let's start with the U.S. Obviously, big news. We are about to head into a second bifurcated, but second Trump term here after the historic election of earlier this month. From an immediate economic standpoint, obviously, one of the big sort of economic things we saw was a big rally in the markets. I understand that that's pretty typical after an election, right? There's often sort of a bump as everybody's like, okay, now we know who's in the hot seat. Markets love certainty and hate uncertainty. The question is this temporary? What are you anticipating? And is this tied just to that usual sort of election? Now we know, or is there more going on here?
Well, I think there is a little bit more going on because if you look at the stock market experienced the largest rally ever after a U.S. presidential election. So I think there's information there. And you cannot ignore what happened to the bond market, because when you say markets rose, it's like, oh, wait, no. Stocks rose, but bonds fell. So I want to spend a little bit of time talking about what information is there, because one of the things that I think you guys will know after sort of hearing me talk for, years now, is that I don't believe in professional forecasting. I believe that financial markets are the best place to go for what's likely to happen over the next year. So financial markets have sort of this 6 to 9 month, year long kind of window of possibilities, right? So I don't construct models that tell me sort of spit out some number for GDP and mortgage rates and all that. I simply look at financial markets and say, what are they telling us based on their movements? Now, I want to be clear. A one-day movement doesn't have a lot of meaning. There's a lot of randomness in financial markets. Even a week of movement, not that much information. So a month, 6 months, a year, there's a lot of information in those movements. So right now we're dealing with 10 days really of information. That's it, friends. So all that I'm saying to you today is based on a really short window of movement in financial markets. So I am not attaching a great deal of certainty to this. So I want to tell you that right off the bat. Once we've been in this for 3 months, right, there'll be a lot more certainty. I'll feel a lot more confident in a forecast based on financial markets. So all that being said, what are markets telling us? Well, the rally in stocks says whatever's going to happen next year is going to be good for corporate profits. Well, we know that deregulation is part of the next administration's platform. So you're going to have lots of deregulation. That's good for corporate profits. And when corporate profits go up, stock prices go up. But also, there's been the promise of extending the 2017 tax cuts indefinitely. Now that we know that the House of Representatives is in Republican hands, it will be very, very easy to extend those tax cuts and maybe even add some additional ones, like making tip income tax-free or lowering the corporate tax rate. That, too, contributes to higher profits next year. So if you guys remember back in 2017, when that tax cut package was passed kind of unexpectedly, it was a little bit of a surprise to folks how easily it was passed. Financial markets rallied. The stock market rallied when that happened. So we're seeing the response to more deregulation and more tax cuts. But the bond market is having its say too. So it isn't just about stocks. It's also about the bond market. And given that most of us care a lot about mortgage rates, which are tied to 10-year treasuries, we've been seeing mortgage rates over the last sort of 2 to 3 months trend down, right? They peaked at 7%. They had headed down to 6%. Where are they now, Jess?
Just under 7, right?
Yeah, just under 7. So mortgage rates are back up. And there's information there as well, because what it suggests is that not only will you get maybe some faster growth in the U.S. economy, no surprise when you have deregulation and tax cuts, but you're probably going to get a pickup in inflation next year. And that gets us to kind of the second half of the policies that are likely to take hold. The new administration has promised tariffs, and they seem to be very serious about it. And we don't know yet if those tariffs will be 10%, 20%, or 60% on Chinese goods, but they're going to be higher than what they are today. Now, I'm not telling you anything that's political. What I'm telling you is that the economic profession and every mainstream economist will tell you that tariffs increase prices, that the country that's exporting does not pay the tariffs. Consumers pay them, and we've already seen companies like Whirlpool, for instance, say we are going to raise prices in response to higher tariffs. So inflation is likely to tick back up. In addition, even if you have cuts in government spending, and there's been sort of this idea that somehow you can cut 5% of government spending to kind of pay for the tax cuts, presidents have tried that. Ronald Reagan tried it. Al Gore tried it. Everyone has tried to make government more efficient, and they have a misunderstanding of just how much government spending is mandatory. Social Security, Medicare, Medicaid, and interest payments take up the vast majority of government spending, and there's no cutting that. Now, you can cut all the discretionary stuff. So I guess, you can make the post office more efficient, perhaps. But that is very difficult to do. It's not just something you wave a magic wand and it happens. So I think that realistically, you could probably have a 2% cut in government spending. You're going to get trillions of dollars in tax cuts, which means a higher budget deficit over the course, not just of the next 2, 3, 4 years, but over the next decade. So all of this is translating into higher interest rates for government debt. So you can't just look at the stock market. You got to look at the bond market too. And what all these markets are telling you is that there is a package of policy proposals that will have a large impact on the economy 1 year from now, 2 years from now, and even 10 years from now. When you look at what's happened to the 10-year Treasury, where interest rates on the 10-year Treasury immediately went up about 50 basis points.
I want to drill down into the inflation and recent Fed activity. Obviously, before that, though, you mentioned the deficit. And I've been hearing an interesting proposal. It sounds a little goofy to me. I want your sanity check on this. So I have heard some discussion actually around the idea that the feds may want to look into paying the deficit with Bitcoin. Can you talk us through that, please?
Have you heard this sort of idea that we could pay some of our debt with just pay it with Bitcoin, right? And we saw a tremendous rally in Bitcoin over the last week as well. So Bitcoin is now up above its highs. It's trading at $90,000, I believe, a unit. So there's been this real enthusiasm for cryptocurrencies. And I believe that comes not because we're going to pay our deficit with it, which I'll get to in just a moment, but it comes from the fact that Gary Gensler, who has been running the SEC, for the last 4 years, he is extremely cautious when it comes to Bitcoin and has preferred to regulate it like it was a stock rather than a commodity. And if you regulate something as if it's a stock, a security, it's a very burdensome regulatory process when it comes to things like disclosure and all of those kinds of things. So basically, you don't have a lot of trading in Bitcoin on U.S. shores. Most of it is done internationally. And what we sort of are seeing is a possibility that Bitcoin will be grossly deregulated, big change in the regulatory environment, which means it will trade in the U.S. for the first time really ever. And that means that the price of it obviously goes up as a response. I don't think it's because we're going to be able to pay our debt. Now, mainly because we don't collect taxes in Bitcoin. So where's the money going to come from? The U.S. government would have to hold a lot of Bitcoin in order to pay our debt with Bitcoin. Now, the interesting thing is the U.S. government does actually hold some Bitcoin. I was kind of surprised when I actually looked into it. I said, well, let me see. Yeah. Does the U.S. government have any Bitcoin? Come to find out, They have less than $20 billion worth of Bitcoin, but they do have some Bitcoin.
I'd take $20 billion. That sounds like a...
Remember, $20 billion in terms of like the U.S. debt, which is, over $30 trillion, $20 billion, not that much. But the U.S. government has holdings of Bitcoin because it has seized them from businesses, just like it seizes yachts and cars whenever there's sort of a federal case. So U.S. Marshals actually hold some Bitcoin. It's it's not very big, but the U.S. government does have a little Bitcoin. So they're very careful though about when they auction it off and sell it, because they don't want to move the market when they do it. So that's kind of the problem there with using Bitcoin to pay debt, because China doesn't want Bitcoin. They want dollars.
Right. We all want dollars. All right. So speaking of which, let's talk about inflation. Let's talk about Fed cuts. We are talking about China in a minute too. The Feds, obviously, they've cut rates the last couple of meetings, 0.5 point September, and then a quarter most recently. There's a lot of talk that I'm hearing that is sort of anticipating another at least quarter cut at the December 17th meetings. Now, at the same time, we have been seeing some sticky inflation. What are the implications here, and what are consumers, just on the ground consumers, going to be feeling, especially in the first quarter? Sorry for the forecasting, but please help us understand.
No, I think that's worthwhile. So it's important for us to make the distinction between what the Federal Reserve does today, right now, and what financial markets are signaling about the future. So it's important to sort of grasp this nuance. When the Federal Reserve makes policy, it is making policy in response to current economic conditions. It's saying, here's where growth is today. Here's where labor markets are today. Here's where inflation is today. And it bases those policies on that. Now, up until this point, Jess, we've been talking about what the stock market and the bond market are telling us about the future path of the deficit, the future path of deregulation, the future path of tariffs, the future path of the government budget deficit. We're talking about the future. So now we're shifting, everybody, and we're talking about, well, what's going on right now? Well, right now, the economy's in that sweet spot where, as we've been talking for the last 6 months, growth is steady, about 2.5%. Labor markets are strong at unemployment rate about 4%. And inflation has now come back to 2%, which is the Fed's target. So that's allowed them to cut rates already twice. Now, there was another rate cut on the table in December. And before the election, financial markets were expecting basically 100% probability they would cut rates in December. That's actually gone down to 60%. So financial markets are suggesting that the likelihood of another cut has actually gone down. Now, I trust the financial markets are the only information I really have, right, about the future. So it's saying that the likelihood is lower. We are going to get an inflation report next week, and that inflation report will give us some information that the Federal Reserve will have before its December meeting. So they will have another read on inflation. We'll see whether it goes up or down, and that will definitely influence their decision. I suspect they will be looking at the bond market as well, just like I am, to give them a sense of what are the future inflationary pressures, and do we want to take those rate cuts off the table? So again, they're in a really difficult spot as well, where they're having to balance the reality of today, which looks very, very different than what markets are telling us the world is going to look like in 6 months. So there is the split. It's a tricky time.
Let's talk here about housing market and what are we going to see. We continue to have a massive issue when it comes to availability to inventory on the market. I know there's some concerns I'm hearing out of the construction industry about the possibility of, the tariffs impacting some of the costs of overseas materials. We have around 4 million fewer houses than we need to house folks in the U.S. right now. Where are you anticipating the housing market and what our spring might be looking at in 2025?
It's truly hard to imagine that inventory would go up if the tariffs are successful and the price of any kind of imported materials goes up as well, especially if you combine it with mass deportations of undocumented workers. So I don't think I'm telling anybody anything that they don't know already, that there are quite a few, folks sort of who are in the building trades that are undocumented. Now, there have been, numbers bandied around in the millions. I don't think that that's logistically possible. I think a better read on what actual deportations might look like is the first Trump administration, where in the first 3 months of that administration, 38,000 people were deported, which was pretty quick. Like, it was a big ramp up in deportations very, very quickly. So if you can deport once again at that pace, you'll see roughly 150,000 people deported over the next year, like in 2025. So that's not millions. That's 150,000. So just kind of putting it into some perspective, I think that's probably, what you will see. That's going to impact the trades. It will impact agriculture significantly. I haven't run this number down, so I'm a little nervous quoting it because I don't have a good source. But the source that I saw basically estimates that about half of the labor in ag today is undocumented. But I don't have a source for that, so I'm always hesitant to repeat it. But I'm going to, and I don't have a number for construction, so I'm definitely not going to venture what the numbers are there. But there's nothing to suggest that that's going to lead to more home building, except deregulation could help. The problem, of course, is that most of the regulations around home building are local. So unless you get a push locally to deregulate, I don't know how much that helps you build more houses. In addition, if mortgage rates stay at 7%, then the lock-in effect, which was diminishing as rates were going down to 6%, suddenly becomes real again. So you get folks kind of locked in to their cheaper mortgages if rates stay at 7%. But all that being said, the lock-in effect diminishes over time. And if 7% mortgages are the new reality, because of tariffs, because of deportations, because of all this inflationary pressure. And by the way, when I say inflationary pressure, guys, I just mean inflation at 3% instead of 2%. We're not talking about going back to 8. So I want to be really clear about this. When I say higher inflation, I'm just talking about inflation at 3% instead of 2%. This is not ruinous inflation. It's just higher than what we were expecting, which means interest rates stay higher than what we were expecting. But if everyone thinks that's the reality for 4 years, then if it's permanent, then we all just learn to live with it. Housing markets have functioned quite well with mortgage rates between 6 and 7%. That was what it was in the late 1990s. I know that's been a long time ago. And when you talk about the late 90s, when you've got gray hair.
It feels like yesterday to me, actually.
History, right? But we know that markets can function and flourish with interest rates between 6 and 7%. It's just, do you think they're temporary or permanent? So the effects from temporary spikes in interest rates are different than the effects of permanently high interest rates. And if they're permanently high, then we go back to market fundamentals as opposed to expectations. And so that's what I'm thinking happens next year. Rates stay high. They hang at this 7% rate, but then it comes back down to fundamentals moving markets rather than people going, just going to wait till rates come down. They're not going to come down. So let's just, let the party go on.
Yep. Grandkids are moving. We're moving.
We're moving. That's right. You're moving.
Yeah.
You probably need more sales with cash, right? Rather than mortgages.
Yeah. Yeah. Cash is definitely king.
Yep.
Reports this week out of Europe, industrial output is on the decline. We're also, again, back to the tariff question, which is obviously a hot topic. Now that we know that we have a Trump administration coming in, and that's one of his big tickets. What are we going to anticipate for our European markets here? What are we seeing, and what are your feelings on where we're headed?
Sure. Well, one of my APAC friends once told me that when the U.S. sneezes, the rest of the world catches the flu. And I'm not crazy about cliches, but I'm a little bit concerned that that cliche might be appropriate this time around. We're going to sneeze all over everybody and they're going to catch the flu because tariffs are going to hit any trade dependent country like Germany, for instance, France, very, very hard. Mexico is going to feel it. Brazil is going to feel it. But I want to temper all of that with the fact that tariffs aren't starting in 2024. They started in 2016. So 8 years into a new tariff regime, and the Biden administration didn't eliminate those tariffs. They kept them. So we've been tariffing it up for the last 8 years. Now, as an economist, you guys have heard me say again, I'm not wild about tariffs because they distort trade, and it's my free market trader theoretically knows that they make all of us better off because everyone produces what they ought to produce at the lowest cost, and then we just trade it with each other. And that works beautifully in theory. I know it has problems in practice, but basically, we've been moving out of that free trade regime for 8 years now. So everyone has adjusted to this new reality. You're just going to lop some more tariffs on top of everyone. Europe's problems go deeper than trade. They are dealing with aging societies, just like China is dealing with an aging society. Demographics are not helping any of those countries. And that's true in China. It's true in Europe. They're deeper, more structural problems and trade's just going to make it worse, basically. The tariffs are going to make it worse. But these are problems that existed already, basically.
Okay. And turning to APEC, I probably very similar narrative there. But I also want to hit, China's always a hot topic for us. They're continuing to have their slog. Japan, consumer consumption is actually picking back up. I'm assuming that indicates that there are signs of rallies in Japan. And also there was an article just this week saying that there is some really healthy cross-border investment activity, and in particular in the real estate sector in the APEC region. So again, in fact, I have a stat here. Cross-border property investments showing a 15.7 annual increase across the APEC region. I mean, that sounds hefty to me. So talk through what that looks like and where the tariffs may impact as well in China.
That split between what has been and what will be, right? So you're talking about something that happened in the third quarter when globally rates were coming down, right? So back, in the summertime, central banks around the world had begun to cut interest rates and inflation was coming down globally. And so this was stimulating investment demand. Mergers and acquisitions were back up. So anything that was interest rate sensitive, those sectors were improving this past summer. So that part doesn't surprise me. Remember, too, that the APEC region is one of the few regions worldwide where you still are seeing countries with long-term population growth. So demographics isn't everything, but it does account for a significant portion of growth. One of the reasons Japan's economy is mired in slow growth. When you talk about a pickup in growth in Japan, we're not talking about growing 3 or 4%. We're talking about growing 1%. So again, a lot of that is just demographically being extremely constrained. But don't forget, we've also talked about how improvements in artificial intelligence can go a long way towards augmenting economies that are facing serious labor constraints. So it's possible that AI is seeing most improvement in those countries right now where they're suffering from major labor shortages. All of that being said, it is too early to forecast, number one, how big the tariff increases will be on China. The number's anywhere from 10% to 60%. There is a big difference between 10% and 60%. So we don't know where it's going to go up to this point. And don't forget that tariffs are likely to rearrange economic activity and supply chains throughout the APEC region. So what can happen is China's harmed, but Vietnam is helped and India is helped. So I expect to see some rearrangement of supply chains. But again, this was a trend, Jess, that had already started post COVID as US companies moved to make their supply chains more resilient and sort of adopt sort of China plus one policies and policies that moved production away and insulated themselves from supply chain shocks. So these were trends that were already occurring. We're just seeing them and we'll see them over the next year escalate.
Marcy, thank you as always.